All right, let's talk about something that can feel, super complicated. Indian income tax. But what if I told you it's actually built on a pretty simple logical framework? We're going to break it all down. Seriously, have you ever glanced at your payslip, seen that tax deduction, and just thought, where on earth does that number come from? Well, you're in the right place because we are going to walk through that entire process step by step. Okay, so first things first, before we dive into the numbers, we've got to figure out who the tax system is even talking to. And it all starts with a couple of really basic definitions. You might see this word, assessee, on official forms and get a little thrown off. Don't be. It is just the government's formal way of saying taxpayer. That's it. If you're on the hook to pay tax, you're an assessee. Simple as that. And here's where it gets interesting. The taxman's idea of a person is way bigger than you'd think. It's not just you and me. It's also Hindu undivided families, big companies, partnerships. Heck, even your local municipal corporation counts as a person. They cast a really wide net. So let's get to the real heart of how this all works. The best way to think about it is to picture 5 empty buckets. The very first thing the tax system does is take every single rupee you've earned all year and sort it into these 5 buckets. And this sorting step is absolutely crucial. Every bit of income you have has to find a home in one of these 5 categories. It's how the system takes all these different ways people make money and brings some order to it. This one step sets the stage for literally everything else. So bucket number 1 is the one most of us know best, salary. If you've got a job, this is your world. It's your basic pay, your pension, gratuity, basically anything your employer gives you for the work you do. Bucket number 2 is for income from house property. And this one's pretty straightforward. If you own a property, could be an apartment, could be an office space, and you're renting it out, the rent you collect goes right into the second bucket. Now, the third bucket is a biggie. It's for profits and gains of business or profession. So this covers everyone from entrepreneurs and freelancers to doctors and lawyers. It also includes something the law calls a vocation. So if you're a painter or a yoga guru, the money you make from your skill goes in here. Bucket 4 is for capital gains. Now listen closely on this one. This is not about the total amount you get when you sell something, like a house or some stocks. It's only about the profit you made from that sale. That's the key difference, and that's what goes into this bucket. And finally, we get to bucket number 5, income from other sources. You can just think of this as the ultimate catch-all bucket. Any little bit of income that didn't fit into the first 4, like the interest from your savings account or, a winning lottery ticket, it all lands right here. Okay, so you've sorted all your money into the 5 buckets. Now you just add it all up and pay tax on the total, right? Well, not so fast. This is where it gets good, because the next step is all about legally shrinking the amount of money you actually get taxed on. So here's the magic formula. First, you add up everything from your 5 buckets. That's your gross total income. Then, from that big number, you get to subtract certain deductions the law allows. What you're left with is your net taxable income. That is the number that really matters. So what are these deductions? Well, you can think of them as the government's way of encouraging you to do smart things with your money. You can lower your taxable income by doing things like investing in a provident fund, paying for health insurance, paying off a student loan, or even donating to charity. All right, we've sorted our income, we've taken our deductions, and we've got our net taxable income. It's time for the grand finale, calculating the actual tax bill. Now, this is a super important concept. India's system is progressive. It doesn't just slap one flat tax rate on everyone. Instead, it uses a slab system, which basically means the more you earn, the higher the percentage of tax you pay, but only on the higher portions of your income. And here's how those slabs work, because this is where people get confused. You don't pay your highest rate on your entire income. Your income is sliced up. The first chunk is taxed at 0%. The next chunk is taxed at, say, 10%. The chunk after that gets taxed at 20%, and so on. Your final tax bill is just the sum of the tax from each little slice. Now, for anyone running a business or a profession, there's one more quick thing to know. It's about when you count your income. You can use the mercantile system, where you record income as soon as you send the invoice. Or you can use the cash system, where you only record it when the money actually hits your bank account.
Okay, let's just take a second to clear up something that confuses a lot of people. We hear about income tax and we hear about GST all the time. They're both huge taxes, but they are completely different animals.
Here's the simplest way to think about it. Income tax is a direct tax. You earn money and you pay a portion of it directly to the government. GST, on the other hand, is an indirect tax. It's baked into the price of the stuff you buy, whether that's a cup of coffee or a new phone. The shopkeeper collects it from you and then passes it on.
This really says it all perfectly. GST is a tax on what you spend, paid by the person who's actually using the stuff. Income tax, that's a tax on what you earn. Two totally different things.
So there you have it, the blueprint of how Indian income tax really works. Now that you've got this framework of buckets, deductions, and slabs in your head, what's one part of your own financial life, your salary, an investment, a side hustle, that you're going to look at in a completely new way?